Will the stock market crash before New Year's? That is the question we're going to answer in today's market review. As usual, we'll go through the data to see what is the highest probability outcome here, and then of course what you should do in response with your investments. So the first thing we got to do to understand what's going to happen going into the end of the year is to look at incentives. And when I say incentives, I'm talking about incentives of the different players in the market. And this is the same thing that Ray Dalio does, but at a much bigger macro scale. For our purposes right now, let's focus on two groups. One being the professional fund managers with their money, which is, a lot bigger. It's the whale money. And then two is retail investors. So people on Robinhood or even the old brokerages like Ameritrade. And this is really what you always want to do when analyzing any market, because it's not just about the assets in the market itself. So it's not just about stocks in the stock market. It's more about the actual people buying and selling those stocks. You want to know their motivations. So that's what we call playing the player. It doesn't matter if a company is super undervalued. That doesn't mean that its stock is going to go up. You need people to come in and buy it, because when we break down the market, like I always say, it goes back to Econ 101. It's always supply and demand. And that supply and demand is influenced by people. So you got to think in terms of people. And no matter how technologically advanced our markets get, it's still going to come back to those people. So first group I was talking about, professional fund managers. Let's figure out what they're thinking and what that means for the market. So what do we know about fund managers and really anyone? Well, they're always thinking about themselves, right? So their bonus and what they get paid is based off their performance. And that performance check mark, not only does it come quarterly, but the big one is at the end of the year. How did they do for that year? So if they're getting judged on that, they have no incentive to have the stock market go down. They want it to go up, right? They want prices to be as high as possible and for their portfolio to do as well as possible so that they can get the biggest bonus possible. So from that perspective, they're not trying to sell. And all the fund managers are thinking the same way and buying these stocks and pretty much supporting each other as the stock prices keep going up. The only selling that makes sense for these fund managers is window dressing. And window dressing is basically when they're getting rid of their losers and rotating into the stocks that have done the best this year. So that at the end of the year, their boss and their clients are going to see, hey, you have been in all the hot names this year. Even though realistically, they just rotated in because they were wrong. They missed it. Now they're trying to window dress and make themselves look better at the end of the year. And the thing you got to understand about these fund managers that are swinging a lot of money, they have career risk. So when I'm talking about career risk, I mean that they can get fired from their jobs. So that's the reason most of the time you see most managers just track an index. They'll say they're actively managing a fund, but really all they're doing is buying pretty much what's already in the S&P 500. And the reason a lot of managers do that, especially in mutual funds, is because the risk of underperformance is too high. Because if you're not hitting that average that at least the market is doing and that everyone else is doing, then you're going to get fired. And the only reason you would do something different than that index is to get a higher return, right? But in a lot of these guys' bonus structures, the higher return does not outweigh the risk of actually getting fired if you underperform. So they're better off just tracking the index like everyone else, and everyone does pretty much the same, and then you're okay. You keep your job for another year. They can't say you're bad, right? Because the guy across the street did the same thing. So career risk is a big motivator for a lot of these fund managers, which is, again, goes back to the same reason why all of them are buying going into the end of the year, which should keep pushing stocks higher. Now, the second group you want to look at is retail. And for this group, seasonality does play a big role, because what is it right now? It's Christmas time. People are feeling good. And we all have a much bigger spending budget this month than other months because we're buying a bunch of stuff for ourselves and for people, presents. So in the same way, a lot of stores make all their money during this time, and then of course Black Friday, that money goes into the stock market too, because there's more of it. People are willing to spend. So once again, it goes back into supply and demand of the market. And in this case, the demand is higher because people are willing to spend more money. They got to put that money somewhere. So a lot of people put it in stocks. And just generally around Christmas, people are feeling optimistic. They're feeling good. So they think, hey, I got a good chance in this market. And they throw their money in. Another thing that happens that affects these retail investors is Wall Street does go on vacation during this time. So in addition to Wall Street wanting the market to continuously go up during this time, they're also not at their desks. It's the junior guys filling in. And the junior guys aren't allowed to do much. So a lot of the big volume in the market and a lot of the big moves don't happen during this time. You just see that drift higher. And because Wall Street is on vacation, the retail traders that are feeling optimistic and buying, they have more of an influence on the market. You can see what I'm talking about right here. This is the S&P ETF SPY. And the 28th of December, this last bar right here, market went up, but look at the volume. It is tiny. If you can see this down here, you can barely see it. The volume that day was almost 39 million shares traded, where the average 10-day volume is almost 320 million. So this is what happens when Wall Street goes on vacation. This volume is super low. So then retail has more of an influence. So these factors that we're talking about from both the pro fund managers and the retail, they combine together to give us what's called the Santa Claus rally. And that's when the market tends tends to go up in the last few weeks of the year and over into the first few days of January. So if we look at the Trader's Almanac, which basically tracks seasonality, and seasonality in the market is how does the market do in December versus January going back many, many years. You can't put too much weighting into seasonality. You shouldn't be trading solely off of it, but it is interesting to look at and it does have some effect. So according to that almanac, since 1969, the Santa Claus rally has yielded positive returns in 34 of the past 45 holiday seasons. See, it doesn't happen all the time, but this is a large portion of the time. The last 5 trading days of the year and the first 2 trading days after New Year's, that's when the positive returns come. The average cumulative return over these days is 1.4%, and returns are positive in each of the 7 days of the rally on average. So like I said, those 2 groups and those motivations that we just talked about have caused the seasonality effect, this Santa Claus rally each year. And if we're looking at the charts, yeah, it looks like it's happening again. And I'm recording this pretty early in the morning, but if we look at the futures, they're looking positive today as well. So answering the question, no, we will likely not see a market crash before the new year. But that doesn't mean a correction isn't coming, because we actually think it is coming middle of January. That's what you should be preparing for. Let me tell you why. The biggest factor you should be tracking for this is just general market sentiment. And what do we know about sentiment analysis? What we try to do is understand what people are feeling and then judge the market based off that. And right now, people are feeling extremely bullish. And with sentiment analysis, if people are really bullish, that's actually bearish for the market. And vice versa, if people are really bearish, then that's bullish for the market. So here's an example of 2021 analyst targets for the S&P 500. Every single analyst expects the market to go up. The average is 9% in 2021. Not a single one expects a decline. And that's what I'm talking about, extreme bullishness. And you guys remember we went over these other charts last week showing how many fund managers are underweight cash, meaning they don't have much cash left on the sidelines. They're pretty much fully invested. And when that happens, it's a sell signal, because you got to think, if they have all their cash in the market, then who's left to buy? You always need fresh money coming in, pushing prices higher. Otherwise, if everybody's already in, then what can they do other than sell? Can't buy more. So it's more bullish when you see more cash on the sidelines versus all of it in the market. And you can see here cash on the sidelines is at one of its lowest points. Again, more sentiment indicators here. Investor optimism is at its highest level since January 2018. People are feeling very, very bullish. Bank of America's bull and bear indicator, it is going into sell territory because, once again, people are extremely bullish. And the dumb money indicator says that confidence is at its highest level ever. You see with this blue line reaching new highs. So what this is all saying is that the market is just too hot. People are way too bullish, and that needs to reset, because when people get this bullish, this is when you see a correction. And once the correction happens, then you'll see a reset. They'll come back down to earth. And I mean, even if you just look around, you know people are going wild. I've never seen so many people obsessed with penny stocks at one time. And these are people that have never traded before. Same thing, I'm getting text messages about SPACs all the time and EVs, and it's so annoying. Just speculation has been on a rampage since everybody got bored during lockdown. It hasn't stopped. And it's pretty much gambling at the end of the day. Just look at the number of new YouTube channels that sprouted up with a bunch of people talking about stuff that they don't know about. And the reason this continues to happen is because in this market, anything you buy is pretty much going up, and everybody looks like a genius. I was in our private Slack group through MacroOps the other day in our collective, which with MacroOps, we provide our research to these fund managers, but then they're also in our Slack channel, so we talk back and forth. And they were bringing up a good point that a lot of these retail traders just started their career in March, pretty much at the bottom of the CCPV crash. So from that point on, anything they buy is going up, and they've just developed terrible habits and terrible expectations of what the stock market really is. So they have no idea what a real correction feels like, and it's coming. And it's going to be a real rude awakening for a lot of people. So now the question is, what do you do to get prepared for these market movements? If there's a correction, if there's a crash, what do you do? Well, the first thing you need to do is reevaluate your strategy. And keep in mind, most people in the market right now don't even have a strategy. Now, keep in mind, most people in the market right now don't even have a strategy. A lot of strategies are just, buy every new SPAC that pops up. Oh, it's an EV, buy it. But there's a few questions you want to be asking yourself right now. First is your strategy or method in the market robust? And when I'm talking about robust, I mean, is it going to survive through different market environments? So like I said, right now, anything you buy is going up. It's a very easy market in some sense. But if your strategy is just to buy anything that looks good whenever you feel like it, is that going to work when the market changes? Because the market is definitely going to change. So in our case, with our Fallible strategy, it works off momentum. That's the backbone of the strategy. And that makes it very robust because momentum has worked in the market for the last 100 years. And if it's worked for that long, it's going to continue to work. And the general concept of momentum is like a universal law that's been around forever. There's always been momentum in asset prices, and there's always going to be momentum. So regardless of how the market changes, we know our strategy is going to continue to work. And that's what I mean by determining whether your strategy is robust or not. It needs that solid backbone. And I'm not just talking about pretty lines on a chart or something. I'm talking about a real concept that makes sense that's going to continue to work. So for us, we have the TSI indicator that ranks all the stocks in the NASDAQ by their momentum. And then what we do each month is rotate into the stocks with the highest momentum, the top 5 each month. That way, we're always invested in the stocks that are moving higher the fastest while getting rid of the ones that are lagging. So we stay with the momentum. And this strategy has worked for years. And like I said, it's going to continue to work because momentum is such a solid concept and a robust concept. But that's not the only thing you need in a strategy, because the other question you should be asking yourself when evaluating your strategy is, does it have good risk control? And when I'm talking about risk control, I mean, do you know how much you're investing in each of your positions? Have you calculated that out and tested it? What is the optimal amount to invest? Do you know when you're going to sell shares? Not only when you're taking profits, but also if the stock goes the wrong way, do you know when you're getting out? It's these things plus more that makes up your risk control plan. And that's by far the most important part of any strategy, because that's what keeps you alive and successful in the long term. And for us, with our fallible momentum strategy, that's our main focus. Even though momentum is in the name, really it should be the fallible risk control strategy, because that's just the most important thing, and I can't say that enough. But here's the hard truth about having risk control in a market like this. The reality is that you're likely going to underperform the person who doesn't have any risk control. Our strategy and a bunch of managers I've talked to, we've all had great returns this year, but you know what? Buying EVs and just betting everything on them, they've been working. So when I tell people our fallible strategy is up 60% this year, their first question is, why isn't it up more? And honestly, with our picks and the stocks we've been getting into, we would have done a lot better if we just held on to them. If we did zero risk control, if we didn't take profits, if we didn't respect our stop losses, if we didn't manage it properly and never looked at the downside, we would have done better. We really would have. But that's the mentality. But as soon as you succumb to that mentality, that's when you're screwed. Because, okay, this worked this year, right? No risk control, but it's not going to work long term. And if you get used to it and you develop the bad habits, like I said, a lot of people are developing right now, that's when they set themselves up for failure later. That's when they blow out later. So when we're looking at our strategies, we're always thinking long term, not just for the market right now, but for the market tomorrow too. We want to keep crushing it year after year without taking that major loss that throws us out of the market. Because you got to remember how the percentages work, right? If you lose 50% of your capital, you have to get 100% return to make it back to break even. You never want to take those huge losses. My dad always had a good analogy when he would explain this to me, and he was a fund manager, so he would tell me this stuff as a kid. He was like, listen, you can drive everywhere super fast, 100 miles per hour, run every red light, and yeah, it's going to work out for a while. You're going to get to places faster. But eventually, guess what? If you do that, you're going to die. No doubt about it. If you drive like that, you are absolutely going to die. And that's how a lot of people are managing their money right now. And that's why you absolutely need to focus on risk management always. You need to wear your seatbelt. You always need to be prepared for what's coming. Stop at those red lights. Take that loss when it hits your stop point. Take those profits even when it keeps shooting higher. And yeah, it's tough being responsible because no one understands risk-adjusted returns. Okay, you could have 100% year, right? But how did you manage your risk that year? Did you cut off the downside? Because the same person who had a 40% year might be way better because it was a risk-adjusted return. Again, you got to think long-term in different types of markets. So I guess the last question you got to ask yourself is, are you in it for the short term? Are you just playing around? Or are you actually trying to grow real life-changing wealth over time? The kind of wealth that just doesn't disappear overnight from a few bad trades. And going into the new year, it is a great time to review this stuff. And if you ever want to see the details of our strategy at Fallible, so you could literally take the same strategy and use it yourself, then definitely check out our free training. I'm going to put a link to it in this video and down below in the description and comments. But we go over exactly how it works so you can use it yourself. And a bunch of our Fallible members already use it. They love it. They've been using it for years. And like I said, it's long-term, it's focused on risk control, but it still crushes the market. And I'm excited for 2021 because we're about to do it again. We're going to have a fantastic year. So to learn more about how you can use that strategy, click this link right here. It'll take you to that training and it'll show you exactly what we do. It's a great strategy. It's simple, it's effective, and you are more than welcome to join us. So click this link right here and I will see you in the training.